All right, so Chapter 3 deals all with the income statement. So everything we're going to do has to do with the income statement. It definitely is a little bit harder than the last two chapters. I found out I had a couple students in the other class that once we got through, we're through Chapter 3 in the other class, and we start Chapter 4 tomorrow with them. And they are a little bit confused, and they had applied accounting. So you want to make sure you say something if that you're not getting this. And so on Monday, I will be on the computer. So once you've had time to digest this, you need to let me know. So what we're going to do is we're going to talk about the different transactions, and then we're going to talk about what accounts. Now, there's only two accounts on the income statement, right? What two accounts go on the income statement? Revenue and expenses, all right. So, and what we've seen so far when we've been doing the problems is they're pretty obvious when it's revenue, and it's pretty obvious when it's an expense. So one thing we got to look at when we're talking about the operating cycle is it's a complete circle all the time. And if any of this circle gets broken, we have a problem. Right. When we go out and we buy goods, it's an expense or it's a cost of goods sold. So we're going to start talking about cost of goods sold here in the sense that when you're talking about a Target or a Walmart, those type of places, they have to go buy the goods in order to turn around and sell them. So they're going to go buy the goods, they're going to pay for the goods, and then they're going to turn around and sell the goods, and they got to then collect them. All that happens on the income statement. All right, cost of goods sold is a type of an expense. If you go and buy the goods and you pay for them and you can't sell them, is there a problem? Or what if you sell them and then you don't collect the money? You have a problem. If you buy the goods and you can't pay it back, you have a problem. So this cycle has to keep going. And what happens if the cycle doesn't keep going? The businesses can't pay their other bills. So the first thing you do is you pay your supplier. Because if you can't pay your supplier, you can't buy any more goods. If you can't buy any more goods, you can't turn around and sell them. Now, everybody in here is too young, I believe, to remember a restaurant called Tippins. But other restaurants have done this, and businesses have done this before, where they buy the food, they have to pay for the food, they pay all the other bills, and then all of a sudden you can't pay payroll. So what happens? You show up for work, and there's a white note on the front door that says we're closed. That's how Tippins closed. And Tippins was a family-type restaurant known for their pies. And like they were like in strip malls, kind of like in a strip mall like Deerbergs or something like that. And they were that type of restaurant. Good food. You went for desserts, but they also, it was good food. And that's how the employees found out that they were closed. The waiters, waitresses, cooks, whatever, showed up to work, and they weren't. A sign said we're closed. And they never opened again. They stayed open as long as they could until they were not able to make payroll on the payroll date, and then they couldn't open again. Their cycle got broken. All right? And where it got broken, I can't tell you exactly, but my guess is that somewhere in there, they stopped selling as much to the customer, and then they got out of balance. Not as many people were coming in the store. So we got to keep that cycle going. And then what we're going to talk about today is just the concept of the buying the supplies and paying for it, selling to the people and getting the money back, and then selling the goods out and collecting it back. So those journal entries we've done. Now this is an example of an income statement. We've seen this before, and one of the things you got to remember is you do have to list things out. We have sales revenue and service revenue. One of the questions I get asked is, do I really care if it's sales or service when you're writing it out? Not really. Connect can be very picky. So if you see that it's marked wrong and you're like, but I put revenue, check and make sure you didn't put service revenue when in fact they're selling an item, a good, and then it should be sales. That's the difference. Selling a service is service revenue, selling a good is sales. And then you list out all your expenses. You cannot group them together. You got your totals, and then you come up with your grand total of your net income. Remember the total on the title, not the total. It's going to say for the month ending because you're never looking at one day. Revenue, yeah, you might have revenue for today, but you don't know when you collected it, and that's what we're going to talk about next. There's two different types of accounting. There's cash-based and accrual-based. You and I live in a cash-based world. If we have money in our pocket or in our bank account, we consider the fact that we have money. Right now, I literally have like $1.70 in my pocket. I have nothing else in my wallet. I have $1.70 in my pocket, so when I leave, I can get something to drink to drive home. All right, that's how much cash I have. Now, expand that a little bit. Do I have more in the bank account? Yes, I do. So that's how much I have. Many of us live from the standpoint that when there's money in the bank, we have money and we pay our bills, or we go out, or we do whatever. When you don't have any money in the bank, you don't go out, you don't pay your bills, or you charge it, not a good habit, or you charge it. Right? Depending on if you live at home, you ask for more money, all right? So it's a little bit different, but that's how we live, all right? When we earn money, we use it, spend it, and when we have expenses, we pay for them. I paid 3 bills this morning. Why? Because I received them. You pay your bills when you have them. All right. That's how a lot of businesses operate. Remember the 80-20 rule that I told you? 80% of businesses are small businesses. Most of those businesses operate on the cash base. When they have the money, they pay. That was the restaurant that I talked about, Tippins. When they had the money, they paid their bills. When they didn't have the money, they didn't pay their bills. Right? That's how the majority of those businesses operate. Right? However, and that just gives you an example of, you have expenses in one month, you have expenses. It shows that you're losing money. You're not really losing money, but the next month you have revenue, you have revenue. All right, that's just how it operates, yeah.
So when like a business closes down and like they owe money, do they still owe the money even after they're closed?
They do still owe the money, and the creditors can still come after them, even if they closed. So the people that they didn't pay, they still owe those wages. Now, I can honestly tell you, I don't know if they ever paid those wages. The way that you pay your bills when you close, usually you're going to file for bankruptcy when you're a business, and you're going to pay bills usually in the order of which they are large and how big the company is. So unfortunately for people that are owed wages, you're going to be at the bottom of that list because they're going to be paying utilities and suppliers before they're paying you. And that's just where you're going to fall on the list. As you and I, as individuals, when you go and buy your house will always be the #1 priority on a payment list. And your lender or the person who has your mortgage will always make sure that happens. When you go and buy a car and you take out a loan, the car will have to sign, I can't remember the exact name of it, that basically says, yes, the house goes on top. So the house mortgage company will always pop up to the top of being the #1 person paid in the event of a bankruptcy. And that's just something that they have in most mortgages. If you take out a home equity, same thing. The first mortgage goes on top, then the second mortgage. And so you and I, that's how we are. But in businesses, it's usually based on how much and how big. And you and I usually aren't very big. Doesn't mean we won't get paid. It just means we're a lower priority. Okay. So we just kind of operate on that. If, for example, I taught in the summer, and when I taught in the summer, our expenses are relatively the same in the summer as they are throughout the year. A little bit higher because kids are home. But in the summer, I decide as a teacher, I can get paid 10 months out of the year because that's my contract. I have to teach spring and fall. Or I can get paid 12 months out of the year. I choose to get paid 12 months out of the year. As an accountant, I like to budget things very smoothly. So I want to know a steady paycheck. Then if I teach in the summer, that's extra pay. So in the summer when I taught, and this summer I taught a lot, it was a much bigger revenue stream. So my revenue was a lot higher than it's been in other summers. But my expenses were very similar. So I actually showed, if I was keeping it like this, a higher net income than normal, which is what I was trying to do because I had someone going to college, right? I was trying to show that increase. So this summer, I actually, on a cash basis, was able to show higher revenues because even though it was a normal stream. Now I go back to normal and it zeroes itself out a little bit better. Businesses that sell stock and are an SEC company have to adhere to a different process. They have to adhere to GAAP, which we've talked about, generally accepted accounting principles. And if you adhere to GAAP, then you have to use something called accrual-based accounting. All right? Accrual-based accounting says you need to recognize revenue when you earn it and expenses when you use them. There are 2 different principles that are behind that. The first one is the revenue recognition principle. All right, so revenue recognition says that it's when you earn. And a student in my class on Tuesday, Thursday also used the word, she said this was out there on a video or something that said generate, all right, earn or generate. When do you go out there and make that money? So let me give you an example. I got this email today, so it's a current example. I got an email today saying that the Cardinals playoff tickets are going on sale. Knew it was coming, just didn't know exactly when, right? So let's assume it said Friday, but I didn't look to see when it said, because I'm not buying any. All right, but the Cardinal tickets are going on sale Friday. Are the Cardinals earning that money on Friday for playoff tickets?
No.
No. When are they going to earn that money?
When the games are played.
When the games are played. Because what happens, are the Cardinals guaranteed to make the playoffs right now? No. They did win last night, thank goodness. But they are not guaranteed to make the playoffs. They are going for a wild card seed. They're not number one in our division. They're going for a wild card seed. So they are going to try to make the playoffs. In the event that the Cardinals do not make the playoffs, what would happen with the tickets that I bought Friday? Refunded. They would have to pay me back. So on Friday, if I went online, and all of us went online and bought tickets, all these people buying tickets, the Cardinals' cash account is going to go up, right? They're going to be getting all of our money. You can't buy Cardinal tickets on accounts receivable. Well, some companies might, but we can't. So they can't credit revenue because they haven't earned it yet. What do they got to do? Anybody know the account we're going to credit? Kind of. You're in the right category. It's going to be liability, but it's not. It's our only liability that doesn't end in the word payable. Do you remember what that one was? They call it something different in this new edition of the book, but it's called unearned revenue, or I'm fighting this title. They call it in the book, I guess, the new word is deferred revenue. Unearned revenue, deferred revenue. They're basically saying, this is money you made, but we can't recognize it yet. We're going to recognize it later because it's a liability. In the event that the Cardinals do not make the playoffs, we have to pay it back. So it's a liability. And the Cardinals aren't the only example. Think about any ticket that you buy. Ed Sheeran, I guess, is going to be playing at Busch Stadium this weekend. They showed a thing this morning where they're setting up the stage. Those tickets went on sale. They might have not even been this year. It might have been like before Christmas when Ed Sheeran tickets went on sale. So Ed Sheeran, who I'm sure incorporated himself a long time ago, he can't recognize that money back in December because what happens if he doesn't play that concert? What does he have to do? He has to refund the money. And I heard on the radio or TV or something this morning, we could get 4 to 6 inches of rain between tonight, really Thursday, and Sunday. That's not going to be a very fun concert. All right? So will he play or will it be canceled? If it's canceled, he refunds the money or he reschedules. Another example is airlines. How far in advance do you buy your airline ticket?
Far back.
Usually at least a month, sometimes 2, 3, 4 months ahead of time. So an airline cannot recognize your ticket for flying until you actually fly. Flights get canceled, you cancel flights, you change flights, they cannot recognize it. So that is deferred or unearned revenue. Now, sometimes it's hard to read this little box up here on the screen, but basically they said the first thing you want to do is identify if you have a contract or not. Okay, first, is there actually something going on? Then the obligation, determine the price, allocate it over the obligation. So the Cardinal tickets, you're going to find out how many games, you got to allocate it over the games. Now, for the most part, you're going to be lucky there because it should take place over the month of October. So it's a little bit different. And then recognize the revenue for each performance. All right, now the timing of it. So you basically have 3 different ways in which you can recognize revenue. So this is the good part. Here's the first way, cash and unearned revenue. Then eventually, what's going to happen, this is chapter 4. When the Cardinals play, or Ed Sheeran plays, or you fly on that airline, you're going to take that and you're going to debit unearned revenue, and credit revenue whenever it actually happens. When you earn or generate that money, you will do that. You will debit revenue and credit, no, debit unearned revenue and credit revenue. The second way that you can generate revenue is you can actually walk up to the Cardinal ticket office tonight. Well, actually you can't tonight because they're in Washington. When the Cardinals play at home, you can walk up, buy a ticket, and walk into the game. Cash and revenue. That's the easiest way for the Cardinals. You buy the tickets as you walk in the game. But the fact is, the Cardinals don't sell a lot of tickets that way because they have a lot of season ticket holders. Right? Now, I heard that there were tickets available for Ed Sheeran, but they're all on StubHub. So what's that mean? They've already been sold. All right? So Ed Sheeran probably made his money already. Now somebody's selling their own tickets. All right, and then the third way that you could recognize it is you go out there, and this is more work related, not necessarily like a concert. You do the work, but they didn't pay you. So they owe you the money, and you did the work. So accounts receivable and revenue. And then what happens in Chapter 4 is you collect the cash, and you credit accounts receivable, but you recognize the revenue. So one way is it's cash and unearned revenue. It's a liability until you earn it. The second way, it's cash and revenue. You recognize it right away. And the third way is accounts receivable and revenue. They didn't pay you yet, but you did earn it, right? The three different ways.
What would be an example of that one?
That would be where you go and you painted someone's house, but they didn't pay you yet. They're going to pay you next month. Revenue's earned. Okay. You contracted to do anything at the house, and then they send you an invoice. So this is the same thing we just did. You can see the middle one is the cash and revenue. That's obviously the most preferred. You get the money, you do the work, you walk out. And if you think of anything you have done at your house, like we have a sprinkler system. They actually want us to pay up front, and we actually do. You get a discount if you pay for the whole year up front. They open your sprinkler, they come out twice a year, and then they close your sprinkler. So this is what we do, cash and unearned revenue. But the other way would be they come out and do the work, and they leave a bill. So they did the work, and they bill us. And then it usually takes me at least 30 days to remember to pay the bill. All right, so that would be accounts receivable revenue. That's why they give you a discount to pay up front, because they don't want to mess with sending you a bill. All right, the other principle, so that's the revenue recognition principle. The other principle is the matching principle. Principle. Why can't I spell? There we go. The matching principle says you're going to recognize expenses when you use them. The other word is incur. Use them or incur them. So basically, the expenses that you have, when are you using them up? When are they going away? We said that supplies are an asset. They are no longer an asset as I take this marker and throw it away, because I'm using it up. It's gone. That's what we're trying to do here. So there are three different ways in which the timing of these versus the cash payment as well. The first way is we go out and we buy supplies. We buy them with cash ahead of time. We can buy supplies ahead of time. We can pay for rent ahead of time. We can pay for insurance ahead of time. Now, I pay for the insurance on, we have 3 cars. For some reason, one car we pay for 6 months, and the other 2 cars we pay monthly. All right, it's just been that way since my husband and I got married. When we had 2 cars, now with 3. So the car that we pay for 6 months at a time, I just paid in August. I paid for 6 months of insurance. What were to happen if I were to sell that car and not carry that car anymore? Would they owe me that insurance money back? Yeah, because I don't have that. I still have the other 2 cars, and the other 2 cars are insured. And those cars, as long as everybody's covered on those 2 cars, they would owe me the money back. So what do you think I call that when I pay for my insurance for 6 months? With cash. What would be my journal entry? Prepaid insurance. So it would be a prepaid, in this case, insurance with a credit to cash. I prepaid my insurance, I prepaid my rent. Your book uses one they will sometimes call prepaid expenses. I don't like that because you guys are seeing you debit an expense. I prefer when you say prepaid and name it, because I don't want you to get in the habit of being able to debit an expense, because you don't typically debit expenses. So when you do your adjusting entry in Chapter 4, once you use your insurance, you would credit insurance expense and debit, and credit prepaid insurance. Sorry, debit prepaid insurance. I can't talk. Debit insurance expense and credit prepaid insurance. That's how you would adjust it out. That's when you use it. So this is what happens up front. We are not incurring or using my insurance right now, but we are spending the money to do it. Then when we actually use the insurance, we would actually put it as an expense. The other way we could do it is actually using the expense right now. An example of that would be advertising expense. We debit it and credit cash. You pay for advertising expense for this month and you use it this month. So that would be using your expense as you pay for it. And then the third way would possibly be wages expense and a credit to wages payable. What happened? Well, we had wages in this month, but we didn't pay you yet. Why? Well, because the end of the month fell on a Wednesday, but payroll isn't until Friday. So we had to recognize those 3 days of the week in last month as an expense, and then wait to pay them on Friday with the pay period. So those are our 3 different expenses, just like we have our 3 different revenues. Now the whole time, this is the key word. The revenue recognition principle is great, and you want to know its name. But the matching principle with expenses is key, because it is telling you, let's match them together. Let's put the revenue with the expenses. So let me give you an example, and I'll say it twice, because usually the first time after I say it, you guys just look at me, and then I have to say it again. All right? So you are contracted to paint a house in August. You buy the paint in September. You pay for the paint in October. You paint the house in November, and you get paid for painting the house in December. When do you recognize the revenue, and when do you recognize the expenses? Okay, I'm going to say it again, and don't say the answer out loud so everybody can process it, okay? So, you are contracted to paint a house in August. You buy the paint in September. You pay for the paint in October. You paint the house in November, and you get paid for painting the house in December. When do you recognize the revenue? And when do you recognize the expenses? So think about it for a second. There's not as many of you in here, so to sit there and get a whole bunch of different answers might not work. But who thinks they know the answer? Yes.
The revenues in December.
Okay.
And the expenses in September.
Okay, revenue in December, expenses in September. We have another. We usually have at least 2 different, even if this is a smaller class, we usually have at least a couple different scenarios. Who else wants to speak up? Don't make me call on someone to at least get one. I need at least one more answer. Yeah.
Expenses would be in October.
Okay.
So when you paid for the paint.
When you paid for the paint?
Oh, wait, it was not.
You paid for the paint in October.
What was September?
September is when you bought the paint.
Wait, we said October.
You bought the paint in September. You paid for the paint in October.
Oh, okay.
Oh,
So,
yeah. It's October.
October for you and December. What's you?
Well, that's what I said.
That's what you said. Okay, October. And when's the revenue?
December.
December. Okay. So they agreed. Anybody else?
I agree.
You agree with that too? We got 3 agrees. But I want to tell you they're not right. So does anybody else have an answer?
It's
That's great. But that's the common answer. I will tell you that. That is the most common answer.
Yeah, it makes sense.
Because why? It's when you paid for it. That's how you and I recognize it. We paid for paint in October, so we're going to go, if you guys actually kept a checkbook anymore, you would go write it in your checkbook. And if you kept a checkbook, you would then go write your money in December and be happy because you can go Christmas shopping, right? But that's cash-based. We're accrual-based.
Would it be September because you're getting the equipment?
You're getting the equipment, okay. Now let me go over these processes. You recognize revenue when you earn it. When did we earn the money? When we did the work. When did we do the work? November. When we physically painted the house, we earned it, right? When did we use the paint?
When we painted the house.
When we painted the house, which is November. So you recognize revenue and expenses both in November.
So what was the December thing?
December is when we just got paid,
Okay.
which in our heads is when we recognize revenue because we got paid. When do you recognize your paycheck? When it goes in your bank account. But not with accrual-based accounting. With accrual-based accounting, you recognize it when you earn it. So you and I, for example, I get paid monthly. I would be recognizing my revenue throughout the month, but I don't. I recognize it on September 30th because that's when my paycheck gets in the bank. So remember this matching, when I circled the matching principle? You want to match revenue and expenses. So they should be in the same month because you use the paint when you painted the house and you earned the money when you painted the house. That's weird. Okay, it is weird. It's different. We don't think like that. But they want to do that. And let me give you an example. I'm going to write this on the board. So in the event, think about this. The Cardinals are, let's assume now let's use a baseball tickets. Okay? We can do that. Or let's use Ed Sheeran and his concert ticket. Let's assume that Ed Sheeran sold his tickets last year in 2017. And I'm making up numbers because I have no idea how much they make in concerts. But Ed Sheeran in 2017, in December, sold out his concert, all right, in concert tickets. So his revenue, just for his St. Louis concert, was $5 million. What were his expenses for his St. Louis concert? Pretty much nothing, right? He hasn't done anything here. So he might have had some minimal expenses, but he didn't tour in December. So pretty much he made $5 million. So his income statement looks like he made a net income of roughly $5 million minus miscellaneous expenses. He also had some miscellaneous revenue. $5 million. Then he comes to St. Louis in, September of 2018. He pretty much doesn't have much revenue except for the fact that he does get a cut of whatever Busch Stadium sells and different miscellaneous things. So he has roughly, let's say, $500,000 of revenue come in the door from miscellaneous items, but he has all the expenses. All the roadies that he has to pay, all the buses he has to pay, all the setup, and the stage was huge. So he's looking at $2.5 million, I'm guessing, of expenses. So in September, because this is his only concert, he has a loss of $2 million. Does he really have a loss of $2 million? No. He actually has a net income of $3 million. But because we recognized his revenue back in 2017 and his expenses in September of this year, it looks like he had a huge gain in December and a huge loss in September of this year. So the accrual process says you can't do that because all these companies would have income statements that do this. And you'd never really know how well a company was doing. It would be extremely misleading. You'd have a company do so well for 4 months in a row and you'd invest in them. And then the next 6 months they'd have huge losses because then they'd recognize all their expenses. And then their stock would plummet and you'd lose money. And then the next 6 months they'd have huge gains. And the next 6 months they'd have huge losses. You'd have no way of telling how well a company's really doing.
So is that why they don't do it that way for like bigger companies?
That's why any company that is traded on the New York Stock Exchange, any company that is SEC, and some companies do this anyways, that want to eventually be sold and be traded, have to use accrual-based accounting. They have to match their revenues with expenses so you are able to look at their financials and see exactly how they're doing.
So accrual accounting is pretty much that.
Yep, accrual-based accounting is matching your revenues and expenses. That's exactly what it is.